Period of easy returns is over.
How did you like the Union Budget 2026?
We were not expecting any big boost to consumption given they have done a lot in the last 12 months on both GST and income tax rate.
How should a common man restructure his portfolio, keeping the Union Budget in mind?
The asset quality is quite strong. I think financials should be a mainstay of all the long-term portfolios.
So, what do you think that when our FI is going to make a comeback?
FIs have been selling in the Indian markets because of the opportunities which they find in the other markets.
Which means that the more activity you do, the more you pay as the tax. Unless you do your homework, unless you are disciplined in the way you are investing, it's very difficult now to be able to generate returns on a consistent basis.
Today, to answer all of your doubts about the markets, we have two esteemed guests joining us, Mr. Varun Lohchab, Head of Institutional Research at HDFC Securities, and Mr. Devarsh Vakil, Head of Prime Research at HDFC Securities. We'll deep dive straight into the conversation with one of the very basic questions. How did you like the Union Budget 2026, Mr. Varun?
I think overall it was on expected lines. Few hits and misses, obviously. I think the good part is that the government continued on its path of fiscal prudence, which they have done over last few years. So there was no deviation from that. Second bit was the focus was back on capex, which is a good thing from a long-term perspective and which our country needs given our stage of development. I think the main dampener was the increase in STT, which was coming at a point when generally, the market mood is not the best. But I think again it is targeted at sort of curbing the short-term trading activities, and they want people to think more long-term, which I think is the right thing to do again from a long-term perspective. Just that the timing could have been better, or if there was it came along with some other sort of a boost for long-term investing in the form of lower capital gains or some ways to attract foreign capital. So I think barring those misses or things which we could have probably done a bit more on, I think on most of the other things it was largely on expected lines, because we were not expecting any big boost to consumption given they have done a lot in the last 12 months on both GST and income tax rate. So overall, a fairly balanced, consistent, long-term focused kind of a budget.
And coming to you, Devarsh, as we know that FI has sold over 90,000 crore worth of equities in 2025. In January also, we saw a lot of selling by FIs, more than 36,000 crores, if I'm not wrong. So what do you think? Are they going to make a comeback, or they'll be more scared now since the STT, as Varun said, that it has increased on futures and options both? So what do you think that when our FI is going to make a comeback? Because a lot of our audience and a lot of investors are worried about this particular thing.
So FIs have been selling in the Indian markets because of the opportunities which they find in the other markets. See, other markets like China and Korea, those markets have been quite attractively valued compared to our markets. We had a tepid earning growth last year. And as we know, the prices are basically slave to earnings. And as we expect the cyclical recovery in the economy now, and we are expecting earnings to pick up, I'm sure it is just a matter of time that the FIs will return back. One of the also variable in the mix is the rupee depreciation. Our currency has been depreciating. So though the Indian investors got about 8 to 10% return last year, but if we were to factor the currency depreciation, the returns were very low for FIs. So I think now, once the macroeconomic stability is there and the currency is stable, earnings growth is expected. So we expect FIs to also return. Had they done some stops for them in the form of lower capital gain tax, as many of the market participants were expecting, they could have returned early. But I think it will take its sweet time, but they are on their way back, I think.
A lot of talk is there on the STT. Can you tell a very easy way that how is it going to impact futures and options? What is the practical consequence of this?
See, basically, it's a securities transaction tax, which means that on every transaction that you do, there is a tax, and they've increased the rate on only options and futures and not on the cash transaction.
Yeah.
So if you are buying any stock in cash, there is no change in your taxation. If you are buying in futures, there is an increase. But the bigger, and then like the increase has been quite sharp on the future side, and on options also there is an increase. Now, which means that the more activity you do, because it's on every transaction, the more you pay as, the tax, which means that your post-tax return in a way comes down, especially if you are a very active trader in the derivatives market, which is futures and options. So just to give you an example, something like a arbitrage fund, which is, which basically is for, getting your liquid or, debt kind of a returns, very steady. But they tend to roll positions in future and options market on a monthly basis. Okay, so now if we were expecting around 6% return from them in the pre-budget in the earlier STT regime, now given the higher STT regime, that returns would go down by 30-40 bips on a per year basis. So that's the impact of STT, that instead of a 6% return, you would possibly end up getting only a 5.5% return. And similarly, if somebody is a very active trader and the churn is even higher, then if he was hoping to earn a 12-15% kind of a return, maybe that will come down to, by around 100-150 bips. So it all depends on how much you churn. Basically, the government doesn't want you to trade on a daily basis or on a very high frequency basis. They want long-term patient capital.
Very, very well explained, Varun. Devarsh, as government made an announcement for electronic manufacturing services sector, and then a lot of focus has been on the tourism sector also, because, and as your report said, that will help the hotel industry and also the aviation industry also. So which sectors do you think, considering in mind, how should a common man restructure his portfolio keeping the union budget in mind?
So budget is just one more event. Looking at the investments for a longer term, I think we look at earnings growth and the valuation at which the various sectors are trading. So from that lens, I think the financials continue to remain quite an attractive bet. We think that the RBI numbers, if we monitor recently, the credit growth is picking. The asset quality is quite strong. And we think that the liquidity is going to remain with the bank. So earnings growth will lead to recovery in the overall Nifty earnings, and financials are a large part of Nifty also. I think financials should be a mainstay of all the long-term portfolios going forward. Yes. Apart from that, I think this budget has allocated good amount towards the capital expenditure, especially in the road side, the railway side. So I think infrastructure stocks like cement, rail stocks, and these construction companies, road construction companies, I think these are the various individual stock picking opportunities which will present itself, and we will try to pick those stocks in the portfolio.
And moving to Varun, I think in the last 4 years, from 2021 post-COVID, I think until 2024, there was a big bull run. But now I think investors will be more cautious about, picking a particular company. So how important are the fundamental metrics going to be in considering the next investment for every investor?
Yeah. No, I think, we are in a phase, and we have been calling this out for last, 1.5-2 years, that the period of easy returns is over, which was, as you rightly said, 2021 to 23, 24, anything you kind of bought would have gone up either 50% or 100%. That was the only difference. But we are clearly out of that, phase, and which has been shown in the last 12-18 months, where there has been brutal correction in a lot of stocks, mid and small cap, but at the same time, there is still been phenomenal money being made in certain select small and mid cap stocks, as well as even large cap. So, it's not even, obviously there was an excess froth in small and mid cap compared to large cap, which is always bound to happen in a bull market given the lower liquidity in small and mid cap stocks. But it's very, very stock specific. It's not even sector specific. It has
Yeah,
become stock
stock
specific now.
Correct.
In the same sector, you have some stocks which are falling and some are going up. So unless you do your homework, unless you are disciplined in the way you are investing, it's very difficult now to be able to generate returns on a consistent basis. And therefore, we would strongly advise, investors to either sort of do that homework on their own, which means a lot of effort, or you give your money to professional fund managers, who do this day in, day out, because, I think this phase is going to sustain. And probably, not we are not going to that roaring bull market sort of a situation, because the starting point of valuations is still on the higher side, and the earnings recovery is not going to be like it was post-COVID from a depressed base. So now I think there is going to be a lot more hard work which will have to be done to get the same returns that that one is expecting. And the second, I think the most important part is investors have to tone down their return expectations, which is what we have been saying. People had gotten used to that 20-30% sort of annual return.
Yes.
I think if you lower your expectations to a more reasonable 10 to 15% sort of a band from equities, I think, and if you do your homework, then I think that sort of return is still possible. I would not say that equities as an asset class, and especially Indian equities, can't deliver that sort of a return going forward. But if you are hoping that everything will go up and you will continue to make 20% returns per annum, that is not going to happen.
Earlier, people used to buy, and if it doesn't work, then they used to research. Now it's time where you first research, and once the valuation are in your favor, then only.
Maybe it was like, at that time people used to, fear doing research because the stock would move up and you would miss out, right? So you buy and then we'll see. Now I think it's the other way around. You don't want to be too early because next day you might get it cheaper. So
everybody was an expert, I think. Like post-COVID, everybody used to be like, ye kharid lete hain, wo kharid lete hain. And like research wasn't on the radar, but I think now research is going to be very integral. And coming to you, Devarsh, in the last year, in year 2025, I was reading the data, and more than 2 million investors, active investors, have dropped out of the market. This is still June 2025. There hasn't been a major hit on the, the SIPs, which is like 30,000 crore every month, which comes as an SIP into the mutual funds. So do you think it is going to get impacted if the Indian markets stay muted for a little long?
No, so there are two parts. One is the long-term investment through systematic investment plans in mutual funds and insurance companies. I don't think that is going to change. That is an asset allocation decision which Indian public has taken.
Yes.
Now, rather than just investing in physical assets like real estate and bullion, people have understood the power of equities, the power of long-term compounding, and those capital are coming with a view to remain invested for 5 to 10 years. So I don't think that number is going to come down. In fact, there is a possibility that as the disposable income grows and as we have more awareness, that number is likely to rise. The number which you mentioned, that the active traders are coming down, that has the reason is that, as we've just discussed, the COVID time, a lot of unexperienced youth came into the market, started trading in the discount apps, and especially in the derivatives market where they have done a lot of trading. In fact, in last colloquium, we also mentioned that the environment is changing. Now it is difficult to make those kind of money, and that's why those investors who were just for the sake of short-term trading are dropping out. In fact, in this budget also, since STT has been raised in the derivative side, in fact, there could be some small impact on those numbers. But I think this STT rise will impact more of the high-frequency traders and the people who use algorithm to do very large amount of trading. But that number is not that large. So overall number may not get impacted so much. The transactions may come down from the high-frequency traders because of these new provisions.
Fair. I will ask a question to Varun, away not from the union, but related to the union budget 2026. But we have all seen a crazy rally in gold and silver in the last 6 to 7, 8 months. What do you think? How should one look at after this? What do you think about this whole correction, or it was a much needed fall because since it was a very parabolic move? So, do you have anything on that?
I think it again kind of reiterates the importance of discipline. In investing, whatever be the asset class. I think the rules of the game are the same.
Yeah.
You have to see it's a lot about psychology and herd sentiment and how you have to avoid that. I think that the time to probably buy gold and silver was 2 years back. When silver had possibly a flattish kind of a return in last 10 years. So, probably that was the time to invest. And when an asset class is up 4x in less than a year, and suddenly you start seeing, everyone saying that silver is now used in a lot more industries. I
Yeah.
don't think anything would have changed so dramatically in the, last 12 months.
Yeah.
But it was just a short-term money chasing. Now again, there is a fundamental story to gold and silver,
Yes.
in terms of the way central banks are sort of recalibrating their portfolios, how the end use of, something like silver is increasing in some of the fast-growing industries. So there is clearly an investment thesis, but everything is at a price, right? So the end user industries also will see some degree of demand destruction if silver prices were to sustain at these kind of $80 to $100 kind of a range. So I think what we have been advocating is that precious metal should be part of your asset allocation, which should be possibly around 10 to 15% at max, because they are still not unlike equities where there is a compounding of earnings, and there is a growth behind. There is, in case of precious metals, there is no sort of a fundamental kind of a growth, or there is a earnings compounding story. So they can't be the dominant part of your portfolio.
Yes.
But they provide a good hedge against equities, especially like last year when equities were not performing or were very volatile. They would have helped your portfolios. So one should remain invested in them from a medium to long term perspective, but make sure that your asset allocation does not change when the prices are going up, which means that you are not chasing them at higher prices. In fact, one should have been reversing it, because if you're in your asset allocation, I'm sure with the move both gold and silver have seen, they would, if you had started with 15%, you would have crossed 25% perhaps of your portfolio.
Yeah, exactly.
And therefore there has to be a automatic sort of a recalibration down, that you sell them and buy equities, because right now equities are looking cheaper compared to them. So I think if you keep doing these things in a disciplined way over a period of time, you will end up having sort of better returns, as well as a better sleep at night. And if you chase short term returns, then it comes with its own perils, which is volatility.
That's completely
So it all depends on what your end goal is.
Yes. And Devarsh, moving to you, a very simple question. Well, suppose I'm an investor, okay, and looking at the returns that the market has given me in the last 1.5 years, I'm scared, and I save like 20 to 50,000 rupees a month. Should I restructure my portfolio now? What do you think? Like, if I have a mutual fund exposure, let's say, and I have like 60% mutual fund exposure in the small cap funds, so should I go back to flexi cap or large cap funds, or should I do it sectoral wise, or how should I do it?
I think the answer to that question depends upon individual's return expectation and risk profile. If you have been investing with a little longer term in mind, say you have 3 to 5 years, then larger allocation to small cap is okay, because they are supposed to be giving better return, but it also comes with a higher volatility.
Yes.
Like what we saw in last 1 year compared to Nifty, or the mid cap and small cap, they have fallen lot more. So there are some such phases where those asset classes or those categories will underperform. But if you have the longer term horizon, and if you can stomach that volatility, I think you can continue to invest in that segment. But it all depends. See, there are cycles. There are times where large caps
Yes.
do well. There are times when mid cap and small cap do well. So if you just keep the balance allocation across these three categories, I think you should come out on top.
So moving to Varun, which sector is your pick for the next 1 year, keeping the horizon of next 1 year for investor? What do you suggest?
So see, overall, in our model portfolios for last almost 12 months, we have been very positive on financials, both banks as well as NBFCs. And in fact, public sector banks more than private sector banks, I think, which has worked very well as a call. And I think we still continue to like financials. It's one sector in the markets where, the valuations are not too high. At the same time, earning growth profile for next year, FY27, is going to be better than FY26. And we don't foresee any big asset quality issues.
Yeah.
So that's one sector clearly, which is a large part of our model portfolio. I think then the other good thing is in terms of the two other large sectors, which is IT and consumption. We believe those two we were running underweights in our model portfolio so far. But now things seem to be bottoming out there as well, and incrementally, the commentaries we are hearing from the managements and the sort of results which are coming out, it looks like that clearly the worst is behind. It's not that we are having a very strong V-shaped recovery in these sectors, but earnings trajectory will definitely be better for both these sectors in FY27 compared to FY26. Be it FMCG, be it some of the select consumer discretionary names or IT names. So, and these are two high PE sectors as well. So if they start doing better, then you can say that Nifty valuations also tend to get a support. So those two industrials continue to be a good space to be in. So we have a decent sort of overweight on that sector in our model portfolios. And pharma and metals, we are sort of pharma is neutral. Metals we are slightly underweight, given they had run up very fast. So metals we are slightly underweight. I think within that whole materials thing, we are preferring cement over over metal sector. And I think oil and gas we still have an underweight in our model portfolio.
Fair. And Devarsh, what do you think? Is the fall over for Nifty, or the worst is going to come? Where do you see it in next 1 year? Suppose if I'm investing for like mid-term to short-term to mid-term, I'm not taking 5 years as my investing horizon. So where do you see Nifty by the end of, let's say, financial year 2027? And is the fall over, or is it going to go to, let's say, 24,000? Because
So, see, we have seen a lot in last 1 year.
Yeah.
If you will see, a lot of geopolitical uncertainties were there. India, Pakistan, Russia, Ukraine didn't stop. There were a lot of uncertainty in Gulf. There were also there was expectation that India will wrap up a deal with US, but that trade deal has happened yet. But looking at next 12 months, it seems that most of the headwinds are behind. Earnings are likely to cyclically pick up. We have corrected, as you mentioned, we are near 24,500. These are important support levels, and I think earnings-wise also, if we were to value on aggregate earnings, we are now almost 19 times forward earning, which is a long-term average and just below the long-term averages. So valuation-wise, we have become attractive. A lot of bad news is already in the price. A lot of liquidation of leverage positions has already happened. And I think this is a good level to gradually bottom out. If you were to study the history of last 10 years, usually in the first quarter, between February and March, we usually make a cyclical bottom. And then we recover into the next quarter. So it is as good as any time to gradually keep increasing the allocations towards equity. And in the sectors like financials and industrial, as just Varun mentioned, if you just keep nibbling at those sectors, those stocks, I think next 1 year, you should be able to get fairly good, decent returns from those stocks.
Nice. And considering that the deal with the US is on the way, like it can happen anytime. Of course, they are in the discussions, and there are some things from our side and some things from their side because of which is not happening. But it's going to give a boost as the India-Europe deal, the mother of all deals, has been a big thing for India. And I think thank you so much, Varun, and thank you so much, Devarsh, for this conversation. I think our audience is now well aware of how they can restructure their portfolio. Thank you so much for joining us today. Thank you so much for giving us your time. And I think the audience must have learned a lot about their savings and how they can restructure their portfolio considering the current macroeconomic environment. And thank you so much for watching the video.
Thank you.
Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.